All right. Well, let's try to repost this. I never get the notifications anymore, so
I'm just grabbing my coffee off the machine real quick. I'm back.
All right, I just reposted it myself.
all right. Well, I don't know how long we should wait for. Sometimes we wait for a while, sometimes we don't wait for a while. Do you guys want to just get going? Are you anxious on a Wednesday?
I'm not. I'll give it. I'll give it.
All right. Give it another minute, another couple of sips of coffee to.
Yes, I have a funny dad joke I made up yesterday. We were talking about the football games. One of my buddies said, "Oh yeah, it's like, you know the saying. It's just like the movie. Any given Sunday, right?" So I said, "Yeah, that movie was so good they made a sequel called Any Given Banana Split."
Gosh. Did he laugh or did he just kind of hang up on you?
I took about 30 seconds for everyone to laugh.
Yeah. Well, it was interesting. I don't follow football that much at all, but Patrick Mahomes, everyone knows Kelsey from Taylor Swift news. And during the press conference, I don't even know if it was real. Maybe it was an AI thing, but he said, well, after this year, he has a lot of options and it'd be interesting to see what he does with the rest of his career, something like that. And I was like, wow, he drops one pass and you're throwing him out to pasture already. It was so.
He's old though.
Yeah, I mean,
In football
he has
terms.
Yeah,
and he has nothing to prove really.
Right. He doesn't need any money.
He doesn't need the money, and he doesn't need. I mean, he's really good at his job. So, well, that's about the extent of football that I know. So,
Yeah, I know we've gotten to the depth of my football, which is knowledge, which is really just I only know Taylor Swift adjacent football.
Exactly. That's all right. Well, why don't we're going to get started here. It's Wednesday, December 10th. If you haven't started your holiday shopping, you better get going because it's going to be on you before you know it. Berna Barshay, Robert Marcin, I'm David Maris, Wall Street Beats here. And let's get started. Berna, why don't you have a few things you wanted to talk about, and one of which was kind of checking out the movie theaters. The other was a good place to get presents, Bath and Body Works. Those are the stocking stuffers. If you have a job, you have a career job, getting one thing from Bath and Body Works as a gift for someone, probably not enough. But Berna, what says you about these things?
Okay. Well, the first thing the movie theater thing is kind of off topic, so I'll just throw that one out there. There was a op-ed in the Wall Street Journal that came out yesterday after the close that talked about the death of movie theaters, and which has been something that has been a topic since COVID. But one thing I've been thinking about a lot this week, in terms of the Netflix purchase of the Warner Brothers studio, library, and streaming assets, is it's just how bad this is for the movie theaters. And had the WB assets gone with Paramount or with Comcast, the other suitors, it wouldn't be particularly better. I think the headlines are more histrionic because it's Netflix, and Netflix has had, despite saying on their call, "Oh, we've put 30 movies in the theaters this year." I mean, they put movies in the theaters for like 24 hours, or 5 theaters in New York and LA, and they call that in the theaters, which really doesn't help most operators. Um, I don't think they're gonna not put the next Superman movie in your local AMC, but I think you have to think back to, the Disney Fox acquisition, the acquisition of the Fox Studios, which I think was like 2017 ish, before the pandemic, and I think that was really the first major nail in the coffin of the movie theaters, in the sense that, here are two studios that used to put out north of 20 movies a year together, and now it's a good year if Disney puts out like 13 or something in terms of wide releases. So I think you're going to see the same thing happen to the Warner Brothers output, because there's going to be rationalization across the two studios. And then on top of that, we've had Universal plucking away at the 45-day window. I mean, when I started in this business, there was a 90-day window. A movie came out on in the theaters, and it wouldn't be on pay-per-view for 3 months. Now it's, just over 6 weeks, and you've had Universal chipping away at that, and the other four studios sort of staying in line. But I think Netflix is going to be a bad actor on the 45-day front. And, if we get in a situation where, you get the rare hit, the Wicked, the Zootopia 2, that's in the theaters, and you only get to monetize it for 2 weeks, I don't think movie theaters are going to have much of a business model. Now, there's no market cap in AMC, but there is debt out there, which I would stay away from. And I would stay away from Cinemark. I think that this moment of Netflix, Warner Brothers is this, the patient was already sick, and now they're getting pneumonia in the hospital. Let's put it that way.
Yeah, I was going to
And
ask you, I'm not sure that it really matters, but do you think that this is accelerating just a trend, or do you think
oh,
this is the problem?
it's definitely accelerating just a trend, right? Like, so you had, um, you had the rise of streaming, you had the cost of 80-inch TVs, plummet, and people getting much better home theaters. And then you have a whole generation, the Gen Zs and the Gen Alphas behind them, who have been raised on streaming, and, K-pop Demon Hunters on a large screen in their basement is a movie theater experience in their mind. And that doesn't mean that people won't ever want to go to the movies. I drove out of my way to go see Wicked in a theater that would be bigger, that would have Dolby sound, because that was a movie that merited it. I actually went to the movies twice in the last few weeks. I went and saw the pro tape of the Merrily We Roll Along musical, also in the movie theater. They were both musicals, and they both benefited from having great sound. And so that doesn't mean that people won't go to the movies, but in this article, it talks about something, I forgot the exact numbers, but it was something like in the 50s, like 70% of the population went to the movies every week or something. And, now it's like 5% or something. It's, the numbers have plummeted. And so it's an ongoing trend. But I think that this deal is just yet another thing. And, it doesn't mean that the behavior goes away, but the public company business model of having, there's a real estate mismatch, right? Like, it has a decent business model. IMAX has a decent business model, because when people go to the movies now, they want to go for the big event films or the musicals, or somewhere where having a huge screen and great sound is, and comfortable seats is going to make a difference versus seeing it in your house. So therefore, there will always be oversubscription for what IMAX has to offer, or any of the proprietary formats that I forgot what each of them call them. There's like RLX or something at Regal. They all have different names, but they all have their own IMAX competitor. Those screens sell out first, even though they're most expensive, because that they're meeting the need that people have. We just sort of have a mismatch. It's kind of not unlike what happened with retail. Retailers used to have 900 stores, including in a bunch of malls that are now B malls, and so these big monstrosities that have 20 screens, a lot of which are small, are not meeting the needs. So that doesn't mean nobody's going to make money in movie theaters. There are probably some operators that are overweighted, private operators that are overweighted to IMAX and these large screens, or have, properties in the exact right place where people are still going in the movies. But, the big public companies that have these multiplexes are, they just have a mismatch for where demand is. And it's just, this article yesterday just crystallized it for me. So just stay away from those stocks. It's just such an obvious secular, not that the article was new, but just thinking about WB and Netflix, it's going to be yet another blow to the industry. So that's one.
Only observation, Berna, is what's a movie theater?
Yeah,
Right.
that's it's sad
Well, the
because a
profit
lot of
model
people
is a
don't.
place that sells popcorn, is what it is. A place that sells overpriced popcorn and soda. Yeah, I mean, to the extent that they can shove alternate content in there, but they've been trying to do that for years. Rock concerts, Broadway shows, operas, bringing that to other places in the country than where they happen. But it's not enough. It's just not enough for the infrastructure for the floor plate. So another observation I had yesterday, albeit the stock is up a lot today, which is Dave and Buster's. It's mostly up on the hope that they gave on their conference call, as opposed to having actual good results, because they had. It's kind of like a Groundhog Day situation. Like last quarter, they had negative comps, but they said, "Hey, we exited the quarter, our strongest." The last, sequentially things got better the last few weeks of the quarter, or the first 2 weeks of the new quarter, and the stock went up. Again, they had -4 comps. They missed the comp. People thought they would do better, but again, the stock is up because of saying that things got better the last couple of weeks. And I don't know how many times people will believe them on this, because somehow the end of the last quarter, the beginning of the new quarter seems to do well, and then it backtracks, and we're in this pattern. But not really here to talk about them. It was more like, before I saw the stock section, I just saw their report, and it sort of highlighted the dichotomy to me of what's going on between restaurants and retailers. So restaurants have been putting up really poor results. They're fighting negative traffic. It's all related to macro. They've taken their prices up. People are dealing with inflation. Eating out is highly discretionary. It's sort of like a canary in the coal mine for the consumer. And we saw that reflected in the retailers, that the retailers all just sort of sold off like hard in November, basically, during their reporting cycle. And then since then, we've gotten the news that Black Friday turns out to be much better than expected. Okay, the numbers that we've gotten all point to everyone having a pretty decent holiday season. And this doesn't totally shock me, because unemployment is, last time I checked, 4.4%. I don't know if there's a new number since then. But the bottom line is, if people have jobs and they can pay their rent and they can pay their car payment, it's kind of third on the list is buying holiday gifts. Like, holiday is, an American tradition. Unless you're starving, like, you're going to buy holiday gifts. You might buy cheaper ones this year than you bought last year, but people do not cancel Christmas unless things are very dire. But the behavior of the optimism around retailers versus the sort of inability of restaurants to sort of get out of their own way, and sort of the headwinds there, I kind of wonder if this is the last gasp for the consumer. Like, we're going to enjoy this holiday, and then we're going to have to rein it in next year. And then you put that in conjunction with the fact, and I think there was an article about this in somewhere, a journal or New York Times yesterday, that talked about how a lot of retailers have been able to hold off on price increases through year end, from a combo of having loaded up on inventory before the tariffs, as well as just being willing to take a margin hit this quarter to stay competitive in the highly important holiday marketplace, but that those prices are going to go up in 2026. So that would just be another factor. So, I think this will be a good holiday season, but I'm worried about what happens next year. And,
So, but it sounds like with Play in particular, so Dave and Buster's, symbol PLAY. It sounds like this rally from the bottom of $13 or so to 2021. You wouldn't be like, hey, you know what? This is a turnaround of a century. We need to join in on this. You'd kind of be like either not in it or, and I don't want to put words in your mouth, but I know some people short. But would you short it, or
Oh
would
no,
you just be like, you know what? I'm just
I own a tiny bit of this higher, like, because I was believing the turnaround. I've been super disappointed in it, and I did not add at the lows because I don't see much progress there. I did not kind of like throw my baby out with the bathwater at the lows, but I wasn't adding because there are just other things in my portfolio that I think are more attractive, that are executing better, et cetera, et cetera. I mean, you could argue that I should sell it and move my cash into one of them, but I have a small position that I'm keeping an eye on. So, but my observation there is less about Dave and Buster's and more just about dining out experiences. And I think the overall takeaway why they're having trouble is value. It's an expensive proposition. It's about $40-$50 a person with the gaming, and there is, that seems too expensive to people right now, which is, one of the things that they're fighting and why they haven't been able to get comps up. They have been making some menu improvements, and they did comp positive on the food side, and their traffic is up on the food side. So that is, I think, that is an executional improvement there, but the game side had deteriorated, and I think they're going to continue to have issues on the game side just because of the environment that we're in right now. But my observation on them was more about the larger dichotomy between restaurants and shopping right now. And I think, shopping right now is getting a boost because unless people are literally in dire straits, people do not skip the holiday. All that said, I did buy a little bit of a retailer last week, despite my overall sort of concern about the space. And trust me, I've got plenty of consumer in my portfolio. I just think that, even when I don't like the idea of consumer or of retail, that doesn't mean I'm not active in being long things in the space, because it's important to understand that it's not a zero sum game. Like, it's impossible for an energy company to go up pretty much when oil prices and gas prices are tanking. That's just the way that the industry works, right? So unless you get bought out or something, you're not generally, energy stocks are not going up when you're having a rapid fall in the underlying commodity. You could have a rapid fall in people's consumer spending, collectively, and in the consumer space, and you could still have a stock be a rocket ship if it's taking tons of shares. So you have to understand that, like, my sector thoughts and my individual stock thoughts may differ at any given point within consumer, because it's not a fully correlating sector where all the stocks move together all the time. There are outliers. So anyway, the stock that I bought last week is one that actually, it was Ben's. Ben put it on my radar screen. It's a stock that I've owned in the past, but not recently. I owned it a few years ago, which is Bath and Body Works. And it had a total, kitchen sink guidance for the fourth quarter. They guided terribly for the fourth quarter. A minus, I think they said -8 was the guidance on sales, which is basically the worst sales that they would have ever had in any quarter, and including in recessions. The stock's down to like a 6 PE. I got to check what it is on an EBITDA, but I think what's interesting about this is I've always thought about this company as, even though it's a retailer, it's got very CPG, consumer products kind of characteristics, because they're selling soap, moisturizer, hand sanitizers, things like that. So they're selling consumables, so, and they don't have fashion risk. I mean, they only have upside fashion risk. So they're selling they're selling pumpkin spice in the fall, and gingerbread and pine right now. And there are lots of people who like to change out the scents in their home on a seasonal basis. It's also a great gifting item. You can get stuff for under $10, stocking stuffers, office gifts, things like that. It's down to 6 times EBITDA. This kind of retailer, the only fashion risk they have is when they actually hit like a new scent or a new collab or something that would juice comps for like a quarter or something on a limited edition. But it's not like a fashion retailer where they order dresses and the trend is jeans, and they order narrow jeans and the trend is wide jeans. Like, they're never going to have that kind of giant miss and volatility around fashion. So to me, it deserves a better multiple than your average mall retailer. And so I think the kitchen sinked it. I think it's at a 6 PE is, we've seen this before in specialty retailers, but it's usually when like nobody's going there, the comps are super negative, and that something's broken fashion wise. I think these guys just, maybe it was partially the shutdown. Maybe it was consumer sentiment and mall traffic. I'm not exactly sure what happened there, but even if you look at like the alt data on Bloomberg, like it looks like the time that when they reported the results around mid-November was totally correlated with when the numbers were worse for them. So I just don't see how the mall does well and these guys still do a -8. They'll probably still be negative, but maybe they do a -4 or -5. Like, I just think that expectations are on the floor. And like we saw that, what was it, like 30% move in Abercrombie on their results, which were mixed. They were great at Hollister and terrible at Abercrombie, but the stock had just gotten to a price point, a valuation that anything good was good news. I mean, we see this like with
That was
with
3.2 times EBITDA.
Okay, but it was probably 9 or 10 times earnings, because the balance sheet is a different balance sheet here. But
No, they had $10 earnings, so it was 7. Yeah, Abercrombie was 7 P.
Okay,
yeah, but
so
the point is still the same. I mean, the math might be different, but the point is still the same. That the
math might be a
expectations
little
are
different.
yeah.
Expectations are on the floor, and I would argue that operating, if both of them were sort of mid-cycle in how they operate, I would say that Bath and Body Works deserves a better multiple than Abercrombie, because it's much less volatile in terms of its performance. So
I mean, in the past, it had a multiple, right? It's had a very solid.
oh yeah, I mean, this thing used to trade at like 10, 11 times EBITDA, maybe 12.
Yeah.
I think when I sold it, it was probably 12 times EBITDA. I probably bought it at 9, sold it at 12 times EBITDA, and now it's like 6. So, I don't know what makes it go down from here, right? Like, because I don't think they're going to do worse than -8 in the corner. So I don't think they miss, and I don't think the multiple goes down. So if you're de-risked to the downside, I mean, maybe, it can go to like 15 or 17, but then, you could have a recovery, back to a teens multiple. I just, it's just very asymmetric to me. And that was sort of what Ben saw, that asymmetry, and called it out to me. And kind of just he called it out from a generalist standpoint, and me knowing the company pretty well, not having been paying attention, but just sort of knowing what their customer MO is, it's the price points. We're seeing, I didn't talk about, I guess it's old news now, but, Five Below just smashed it on their earnings. And, we've seen a resurgence in the dollar stores. I mean, when people are shopping right now, they're shopping for value, and these value players are doing well. And this is a value player. And so maybe they sort of hit a road bump in the fall, but I just think it's going to come back because it's in the right place of the value chain.
And you can't go wrong with some champagne toast stocking stuffers from. So now their symbol is what, BBWI, right?
Mm-hmm.
Okay, so all right, well, so that's a value name. Now let's talk about Robert has a value name that's kind of a troubled value name. That's just, or it's not troubled; it's giving him trouble. So, Robert, tell us about Saragon and
Well,
why don't you just give up?
yeah, that's a good question. Because about 5 years ago, I had a company that did the same to me. It was called Calix, CLIX. And they had a new product cycle, and they had an old product line that was fading, and they were going to replace it with something totally new. And I bought it at 5. I sold it at 7 to 9 out of frustration with 6 bad quarters in a row. 3 years later, I shorted it at 80. So
And it went to 160.
I covered a 40.
No, I'm just joking. So,
And then it went to 80 after I sold it at 8 in 3 years.
Yeah.
Okay, because the story played out. So my hope here is that I'm not wrong yet. I'm just a little premature, like I was with Calix, and I don't want that to happen. Now, this stock could never go up 15 times like Calix did. Okay, but I think it could go up, 2 times to start an argument from here, and 3 or 4 times if things went well. So I was in the mid twos. It worked after we bought it. It doubled, but then they pooped the bed on a quarter, and they haven't been able to turn things around since then. But it doesn't mean that there's not a lot of positive developments beneath the surface that are happening. So it's about 4 times EBITDA. There's net cash. They're the leader in the IP in the sector that they function. There's 3 or 4 drivers that are causing 5G telecom equipment to look like there's an upcycle coming. And in the past, when that's happened, these stocks get very sexy. They get valuations because they get cyclical growth characteristics. And I don't mean 5 or 10% growth. They grow, 15 or 20% when that happens. So I have, since the last time I reported on the stock, I've talked to the CEO, and one of their competitors has done something very important. Now, I've bought more at 2 and averaged down. So instead of a 2.5 cost, it's down to about 230. The stock is, say, 210 today, 205. And we're in a bull market. So for me, in my portfolio, that's an unmitigated disaster. Okay. That's about as bad as it gets. And you own my other unmitigated disaster, which is TELA, which I have about a 15 or 20% loss in too. So they're my bad ideas. And if you can keep your bad ideas to this and bail and move on, that's not a bad outcome. But in both of these, I think there's reasons to own them. So I'm sticking with them. In Saragon's case in particular, the company mentioned that they have a lot of momentum with new products, and the CEO on the last call was more bullish than I've ever heard him. But then he was asked a question by an analyst, and the analyst said, "Well, can you translate that that optimism into next year's numbers from a higher level? No guidance, but just think like what kind of numbers of revenue growth are we thinking?" And the analyst specifically said, "Well, could it be, mid-single digits, which is normal, or much better than that?" And the CEO said, "Well, we're not giving guidance, and we haven't completed our budget yet for next year, so we don't want to be specific, but use mid-single digits as a baseline." Well, suddenly everybody said, "Well, they just guided to mid-single digits." And on the call, I told the CEO, if they grow mid-single digits next year, I will personally lead the charge to replace you. Okay? So he actually got a good comeback. He said, "I'll gladly resign, Robert, if you take the position." So anyway, he got me back. Because I don't want that. So it's half of sales. It's 4 times EBITDA. There's net cash. They have the best IP in the business. It's not a great business. The selling microwave equipment that extends cell phone networks for for data. It's the only, they don't transport a lot of voice through this. Most of it's data because it doesn't switch. You can, but it doesn't switch. So you can't have a handoff like a cell phone from cell to cell. So they're line of sight and they're fixed. So they're the plumbing of the cell phone network. And 5G spending has been terrible now for 3 years. It's been in a down cycle. It's so bad that their biggest competitor, Nokia, has decided to take its competitive division against Ceragon, take it out of the corporate financials, and put it in a category with two other divisions that stink and do $1 billion of sales and lose $100 million a year. And if Ceragon salespeople are so incompetent that they can't win business from Nokia customers, because Nokia just said, sorry guys, this is not part of our future. So we're going to put it in a portfolio of shitty businesses, not report them. Report them as one lump, and then we'll decide what we're going to do with it in calendar 26. If you can't win a sales pitch against that competitor, you suck. So if Ceragon, now people aren't going to rip Nokia equipment out, okay? And if they have an order that's in progress, they're not going to not take Nokia equipment because they don't know the future of their vendor. But I guarantee you, if you're a new customer and you're looking at new projects, Nokia is going to get 0% share of new projects because nobody knows what's going to happen with the company. So there's a whole bunch of reasons why this could be a miniature version of Calix, and I could see them making 50 cents a share in earnings in 3 years, and trading at a 15 to 20 PE stock, because they're growing double digits organically. So once they start growing, 10 to 15%, I don't see why a 15 to 17 PE, 18 PE would be horrible. So that's $7.50 to $10 in 2 to 3 years. So that's where I was when I bought it. That's where I was when I didn't sell it with a double. It didn't even do my 25% by 100%. When you double your money, you sell you sell a quarter of your shares for half of your original capital. I just deferred on that because I thought I had a better shot at the next 2 points being up or 3 points being 8 than back to 2. So that was a mistake. But from here, if they keep executing like they talked about on the last call, but haven't yet reported numbers, I think the stock is double or triple in 12 to 18 months easily. So I've never not had a hardware company with mid to high 30% gross margins and net margins in the high single digits not go to one-time sales. And
all right,
I've been doing this
yes.
since 1982. So I'm about 15-0 in buying stocks at half a sales. There's not a lot of companies at half a sales. Abercrombie was there, but not a lot of companies are half a sale.
Yep. So CRNT.
Yeah,
so
it's a $200 million market cap. It's a chicken shit company. It's headquartered in Israel. It's very Americanized, but it is headquartered in Tel Aviv, I believe. And it's a global company because the Israeli 5G market is probably tens of millions of dollars a year, and these guys do 400 million in sales, and Nokia does 400 million in sales, and then they have another company called Aviat in the U.S. that does 400 million in sales. And the Aviat CEO told a sell side analyst buddy of mine it was when, not if, he would own Ceragon. So you also have the shot of there being a takeover. Nokia, if Nokia was going to stay in the business, Nokia would have been the most logical buyer of Ceragon. Unfortunately, it seems that Nokia has to, get real or get out. So Nokia may decide to buy Ceragon and make the business big and profitable, or they might decide to exit the business, and then Ceragon would be a logical buyer, except the fact that they have a $200 million market cap, and it's hard to buy a $400 million business with a $200 million market cap. So I don't think they could afford them, even though they would like to buy them. So,
all right. Well, see. Okay, so Saragon, it's $2 a share. $2 a share. CRNT, good stocking stuffer. If you're going to spend $100 or $200 on somebody for a holiday, you might as well give them 100 shares of Saragon. According to
100 shares of Saragon and forget about it.
Yeah,
maybe someday it'll be worth $1,000 by the time they get to grade school.
Well, what's interesting, what I think, just to tie up today, what I think is really interesting about today is that you actually have two charts that look kind of similar. If we're just going to focus on the Bed Bath and Bath and Body Works, sorry, not Bed Bath and Beyond.
Bed Bath and Beyond went to zero, buddy.
Yeah, exactly. So it's
went to the great beyond.
Exactly. All the BB stocks, BlackBerry, Bed Bath and Beyond. Okay, but BBWI. The charts look the same, and you mentioned something, Robert, that's interesting. In a bull market, when you own something that's not going up or that's going down, it's doubly painful because you could put your capital to work in just the S&P, and you're like, okay, great. So you're marking not just to market, but you're saying, well, look at what's going on. But these are two stocks that are like not NVIDIA, not the things that everybody's talking about, that are, hey, listen, I'm looking for value that, because right now, if I'm going to go and chase a chip maker, I might be overpaying. And so looking for things that are, $1 worth of value selling for 50 cents. So hopefully that's how both of them turn out. I did, while we were speaking, buy a little of Berna's stock, but not so sure I'm going to do the Saragon. But it's pretty convincing. How much can I lose? $2. So there we go.
I would say you can make
downside is capped.
You can make $6 and lose $1. I would say it's $5 or $6 return to risk. Yes.
But see, that's the point of that. Like, in a bull market, you want to buy the winners because people are going to keep throwing money at winners. And the question is,
until year end, and once the calendar changes, then they're going to look for all the losers that were suffering from tax loss selling. This will be over in a month. The pressure of tax loss selling in retail stocks, in nano caps and micro caps, is very real, and I think that's part of the process for these stocks that are.
That's a good point.
I'm looking at my tax loss selling candidates where the fundamentals give me hope for next year, even if they pooch the bed, this year. So,
all right. Well, everybody, this is let's wrap it up today. So if you want more of the chat and what we talk about offline, more of the details, go to wallstreetbeats.com or passes.com/wallstreetbeats. Sign up for the behind the scenes chat, some documents, some of the things that we write about. And we'll see you at the next show. For Berna Barshay, Robert Marcin, I'm David Maris, Wall Street Beats. Have a great rest of the week.
Thank you, guys.
Bye.
All right, I'll buy a little Saragon. Let's see. Let's see if I can get it under $2.